All right, guys, Cisco just reported. You can see after hours, it's up 5.5%. They reported 86 cents per share in EPS versus 84 cents estimate. And they reported revenue of 13.6 billion versus 13.31. Guys, as a value investor who's long-term, I could not care less of how they report on a quarter-to-quarter basis. However, with that said, I use these quarter-to-quarter results to let me buy in when people are overreacting to short-term results. In this situation, I'm not buying it on Cisco because it's up. And I look at it saying, guys, they're not going to hit every single quarter. And the quarters they miss, I'm hoping that it's done during the time the stock is down, blow my buy price, people overreact, and I'm able to buy more shares. I care about the long run of the business and evaluating that. Don't you think, Mo?
Yeah, absolutely. It's all about the long run. But like you said, use these to your advantage.
So guys, this is the historical chart for Cisco. All-time high of $82 on March 26th, 2000. Okay. There are probably people watching this video right now who weren't even alive back then.
I thought you were going to say 2020. Weird.
Nope, 2000. Guys, this is proof that in the long run, stocks go to where their fundamentals are. Look at their revenue. In the last 12 months, they've done $51 billion in revenue. Back in 99, the year before 2000. I
assume it was way more.
It was not.
Oh, really?
It was $12 to $19 billion. So they're almost four times larger. And yet their stock is down. Why? Because if you overpay for a growing thing, you will still lose in the long run. That's exactly what I'm trying to do here. When I talk about this over and over, in the short run, stocks are a voting machine. In the long run, they're a weighing machine, as Ben Graham has said, and as Warren Buffett and Charlie Munger have made ever so famous a statement. So with Cisco, the stock is down a lot from its all-time high of 86. In 2000, it was one of the companies that everybody said this is going to be the first trillion-dollar company when it hit $500 billion market cap. It has even come close to $500 billion since then. Keep that in mind. The reason to watch this channel, if you're new to us, the reason you need to subscribe is this explains the long run of stocks. This explains exactly why a stock that hit $86 in 2000 can go down for 22 years overall. Why? Because the fundamentals did not match the stock price. And the euphoria of the short term overwhelmed everybody in 2000. They didn't care about buying a business, which is what you're doing when you buy a stock.
And even during the wild tech run that we saw in 2021, the high was $63.40.
$63.
Out of and think about all the tech that so many companies went to trillions of dollars, multi-trillions of dollars.
Now, if you bought the stock back in 2000, you probably would have made a little bit of money because they pay a dividend. So this is the 8 pillars on Cisco. The only thing they have an X on is cash flow in the last 5 years is down $83 million. But keep in mind, they did $14 billion as an average the last 5 years. So $83 million is literally less than 1% of that. Okay, big deal, right? Big deal. All right, so from here, we like everything. They're buying back shares. Look at their 5-year PE, 20. Not awesome, not great. But guys, this is a slow-growing company. You saw their revenue over the last 5 years. It's not much. It's a very flat business. Now, I think inflation will help this. And let's go see what analysts are saying about this company going forward. EPS growth, not much. Yeah. Mid-single digits. Revenue growth, not much. Yeah. Low single digits. So how do you make your money on the stock? You buy it cheap as F. They buy back shares. They pay you a dividend. And that's how you make your money on the stock. So you got to buy it super cheap when there's low growth.
Right. And they pay about a little less than half of their cash into the dividend.
Oh, good. So they can afford
it. Good thing.
And it pays a healthy 3.4% dividend
Exactly.
yield.
And even though it's almost half of their cash, that's fine for a company like this.
Oh, 100%. I agree with you. Because that's how they pay their investors back. So guys, with low growth companies, you got to assign a very, very low multiple of earnings and cash flow. That's just it. Don't be afraid of low growth companies. They do have a high return on invested capital, ironically. They do get a 20% return on the money invested in the business. So Charlie Munger said, even if you overpay, your long-term return should be about where the ROIC is. I don't necessarily agree because he's talking to the people out there who believe, oh, $86 for Cisco, I'm overpaying. But well, in that case, all you would do is buy the highest ROIC of every company, no matter what.
Just roll with it.
Just roll every single month. Who's the highest ROIC? Buy them. That's not the way it works. Because if you overpay, you screw yourself completely on that. So if you like what you hear so far, please subscribe to the channel. We do reaction videos every single day to earnings or something. We do 2 or 3 videos a day. We have our community at everythingmoney.com that you can join. It's wonderful. Let's go evaluate Cisco and what we think we would pay for it today based on our assessment for the future. This is our stock analyzer tool. 10-year analysis, you can do 1 to 20. Revenue growth, profit margin. By all means, pause this, rewind it. If you have our software, if you're a member of our community, pause this channel right now. Pause this video, do your own analysis first, and then watch us to see how it matches up, all right? So Mo, let's you and I start putting our own numbers in, and we will go from there. All right. Slicing and dicing. Okay.
Oh boy.
You know, it's really hard when it's such a slow growth company to decide what to do here.
And the PE.
Yeah, the PE is tough.
It is. I don't think Cisco's going anywhere. That's the good news.
Yeah, Burrs, I agree with you.
All right.
All right, you done?
Yep.
Oh, I might have been more conservative than you.
I think you probably, I didn't look yet, but I'm going to look. Did you go negative? You did.
I did. Yeah. So I don't think negative is likely, but it's not a growing business and naturally come from a business that doesn't have, and the other thing is they have to hustle. It's not like Home Depot, we talked about the other day. I'm like, listen, people go to Home Depot day in, day out. They're going to continue doing that. I don't know about it. So I did -1, 1, and 3. Mo did 0, 1, and 2% revenue growth. I did a profit margin of 17, 18, and 19. Mo did 18, 19, 20. I did free cash flow of 24, 26, 28 because it actually has a significantly different. Mo kept his the same. And in the long run, it should be the same. Yeah. But I'm glad here that their free cash flow is higher than their net income. PE, I did 10, 12, 14. Mo did 11, 13, 15. And I think 11, 13, 15 is, like, I look at it now going, yeah, I probably should have done that. But either way, and then desired return, I did 12, 13 and a half, 15. Mo did 12 and a half, 13 and a half, 14 and a half. We hit the analyze button. The stock's currently at 47. I have a low price of low 20s, a high price of 30 to 35, and a mid price of somewhere in the 20s. And I added to my watch list at 35. That doesn't mean I'm buying it at 35. Mo's numbers?
Yep. Low end of 20, high end of about 25.50, and right in the middle at about 22.50.
So Mo's actually being a little more conservative than I am, and that's fine. My guess is 30 is probably the number where you want to be at. That's why my watch list is at 35, so I can start selling puts on Cisco to start buying it at 30 or less. So guys, again, please subscribe to the channel. We do things a lot differently here. We're actually real value investors. We don't believe that just because we have a microphone that we're smarter than everybody. We just know we are. Just kidding. Thank you very much. Stop watching those other hype channels. They're all dumb. Stock Mo, all those other losers. Jeremy from Financial Education. Talk to you later. Thank you.